Is it possible that the S&P 500 could triple by 2030? That's only 5.5 years from now. Tom Lee, a Wall Street strategist with over 25 years of experience in equity research, has made this exact bold prediction. Let's see what he said.
Let's ask the man himself, because he's sitting right next to me. Tom Lee, good to see you.
Great to see you, Brian.
You have not been drinking?
No.
Okay.
Not recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay. Well, there's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens.
Okay. First off, if you go look back at history on when stocks have annualized returns in the high teens, they are never, and I mean never, at a point when the cyclically adjusted PE ratio, when the stock market to GDP ratio is at these levels. The idea that stocks will return greater amounts when stocks are high relative to history's value is absolutely asinine. Right now, we just hit the highest level in over 40 years. 1982 was the lowest level on stock market to GDP ratio, as well as the 10-year cyclically adjusted PE ratio. And that's when we hit mid to high teens in returns for the following 5 or 10 years. Not in 1999 and 2000. Not in 1966. Not in 1928. You've got to remember, the more you pay for something, the less your return will be. It doesn't happen when price relative to value is at extreme levels like we're at today.
You know, you had the roaring 20s, and then you had the 50s through the late 60s. Mm-hmm. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
Mm. So is this the law? Okay, so math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a
demographic.
So the idea here is that they're going to start saving more and more money. It's going to be driven in ETFs to drive stuff. I actually don't disagree with that premise. I do think that's very valid. As more and more people save more and more, and they put into mutual funds and low-cost ETFs, those ETFs are forced to buy equities, and that drives up the value. And I have a question for you. What happened in 2022 then? What happened there? Now, I think the pendulum has swung all the way to the other side. We have euphoria all the way over here. Eventually, we'll get to that other side. How? I don't know. But every investment's the present value of all future cash flow. And when you pay a lot of money for that cash flow, your returns are going to be lower. That is a fact. That is math. Now, could that cash flow be a lot greater than I expect? Sure. But he's not saying that here. All he's saying is a lot of people are going to invest, and therefore they're going to drive up the stock values. For it to triple, that doesn't happen usually just because of driven. I mean, look at since COVID. We haven't tripled from even the COVID crash. We have to hear things like this. Now, does it mean that the S&P is not going to go higher? No, of course not. But to get to 15,000, right now, we're 111% overvalued based on all data going back to 1928. Overvalued. The stock market GDP ratio is at 195%, which is 111% over the historical average. To get to 15,000 by 2030, obviously fundamentals would get better. Things would get a little bit better, but that would have to take us to 200 to 250% overvalued in the next 5 years without any sort of hiccup. Is that possible? Sure. Is it probable? The problem I have, the reason I'm criticizing this is not to say that 15,000 won't happen. To have the justification for 15,000. That's what boggles my mind.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. On top of that, we have a really big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
Do you have a view? Is this because we're the United States? I mean, And do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems, will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. That's roughly $3 trillion of labor shortage, of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to, have a $3 trillion revenue run rate. On top of that, if U.S. companies are growing earnings at this speed, the PE multiple of the U.S. should go up, and that's exactly your point. There's going to be capital flows into the U.S.
PE multiples don't just go up because they go up. A dollar is still a dollar of earnings, no matter which way. Now, I will say this. Do I think that the overall PE multiple may have to increase? Yeah. Why? Because 100 years ago, if you wanted to make money, it was very capital intensive. You had to go build factories and all these things. Nowadays, you don't have to. But at the end of the day, if you can get 5.4% return on 90-day treasuries, what do you have to make in equities to justify investing in equities? And right now, our stock market relative to value does not give that return. That's the big key you have to understand. If the market today fell in half, it would make a lot more sense. If it fell by 80%, you know what the funny part is? Everybody would be saying the stock market's a place to lose money. And I'd be like, wait a second, this is exactly where you should be buying when prices are low. That is what it takes to be a successful investor.
I mean, it is amazing to me that Nvidia alone, folks, Nvidia by itself is worth 50% more than the entire German DAX index of stocks combined.
Yes.
The 30 biggest companies in Germany, or 33, however many are in the DAX, combined are half the size of Nvidia.
Yeah.
Because we have liquid capital markets. We have American ingenuity. We have an amazing workforce.
Because we have euphoria right now. It has nothing to do with those things. We have euphoria. Even during terrible times, the pit of the Great Recession, we still had all those qualitative things he just mentioned. We still had the best workforce. We still had all the capital. We had all those things. Was capital tighter? Absolutely. But the capital still existed. The workforce still existed. Were they unemployed? Yes. That was the right time to buy. Nvidia is not up because according to your logic then, great, all those things exist for all the other companies in the S&P too. Why are so many not like Nvidia right now? Now, the argument back, which is a logical argument, is Nvidia's cash flow is growing a lot faster. Absolutely. And you absolutely should pay more for faster growing companies. But the question is how much more? That's what I'm trying to teach whenever I talk about this. I'm trying to teach that process of saying you should pay more for better quality, for faster growth, for higher margin, etc. Now, what usually ends up happening is the stock has run up a ton. So we think, oh, this is the right price. And then it goes up more. And now, oh, this is the right price. Because we always try to justify what our prices are.
It's a bold call. What's the risk? When you look at it, you've always got to analyze, say, well, where could I be wrong, right?
Yep. Well, I think there's a risk that we could have
global recession.
A global recession. AI, of course, could become an adversarial development and, upend state nations and cause chaos. But we could also have a risk that it's a bubble and it peaks a lot sooner.
To me, this is a cop-out. Oh, recession. If that is the risk, then you shouldn't be making this claim because recessions are common. They just haven't felt common. This is a BS cop-out.
Yeah, and you wonder, by the way, this is a little bit off topic, but I saw some huge bets being placed. And there was a note today, and you forgive me, a senior moment. I can't remember exactly who put it out there, but that there was a huge bet placed in the interest rate market that the 10-year would be at 2.25% by like next March. That there'd be this massive decline in yields, either because of the Fed or recession.
So what would happen? For yields to drop that much, what needs to happen? For the 10-year treasury to go from 4.329 down to 2.25%. Would the U.S. economy doing awesome or terrible for that to happen? Remember, rates go down because the Fed lowers rates. Fed lowers rates because they want to spur growth. They spur growth because things aren't good. They're recessionary. So a major question being asked is, what would have to happen for the S&P to get to 15,000? It absolutely is possible. Is it probable? Well, guys, if you look at S&P and you look at the history, you have to sit there and say, what earnings multiple? Let's say that you think the market should have 20 times PE, okay? Historical average is 15 to 16. Let's say it's 20 times PE, okay? On a 10-year basis. Right now, we're at 36. For the S&P to hit 15,000, that's 3 times more, 3x from today. So that would say today's 36 and make it 108. But we wanted at 20 times PE, so the valuation has to be 1/5 what it is today. Now I'm doing a lot of math here, but essentially 5 times more profit on the S&P from today. So the S&P's profit went up 5x. Now, for those of you who don't know, 5x is 400%. 400% growth in the next 5 years. What is that annualized? That is 38% growth per year for the next 5 years in earnings on the S&P. Historically, earnings S&P is about 8%. So, is it possible? Sure. Is it probable? I don't know. I don't think so. Could AI drop that? Maybe AI does that. But then what happens to the world if AI takes over and all of a sudden all these great laborers they talk about aren't working because AI has replaced them? That's the big key. And I want you to think that way about every company. Like we talk about Tesla. This is a great example. Everybody's talking about that there's a tech company because of full self-driving their software. Well, I was getting a back and forth with a Twitter follower that I really respect a lot on Twitter. And he said, well, Paul, blah, blah. I said, listen, for them to generate trillions of dollars in free cash flow, like he said, in the next 5 or 10 years, Tesla would have to have 200 million cars on this earth using their full self-driving at $100 per car. 200 million. You guys got to remember, worldwide, we sell 50 million cars a year. So it has to be all the cars for 4 years. 4 years. Every single car buys full self-driving. Every single car. Is it possible? Sure. Is it probable? That's the question I ask. And investing is all about probabilities. That's why I encourage, if you do want to pick stocks, to pick stocks based on a process you believe in and buy 10 or 20 of them that make sense to you, that fit that criteria. Because you're going to be wrong on a chunk of them. But when you're right, you're going to be really right. And if you're okay, you're going to do fine. That's the big key here. The other comment is, well, Paul, where do you think stocks are going? Well, I don't think the next 10 years are going to be good. I actually think stocks will be lower 10 years from now than today. I know that sounds crazy to think about. 10 years of losses, but let's look at history. We're at 111% overvalued right now. Let's go back to the other major market bubbles. Let's go back to 2000. In 2000, the peak we hit was 55% overvalued. The next 10 years was negative 2%. Over the next 10 years, negative 2% per year. All right, that's just one time. Let's go to 1966, the last time we had a secular peak. We weren't even that overvalued. We hit a high of 30% overvalued. The next 10 years, negative 1 to negative 2% per year. Okay, that's another time. Let's go back to the previous bubble of 1928. 168% overvalued in 1929. The next 10 years, negative 7%. We didn't get to a positive 10-year return until 1931 when the S&P fell 66% from 25 down to 8. And by the way, it was the S&P equivalent because the S&P didn't start till like 1957. But guys, when prices are lower, returns are higher. When prices went lower, returns went higher. As it got back to even, let's go back to negative 30%. Okay, it's still undervalued, 8.3% per year. Do you see the correlation? The more you pay relative to the value, the less you're going to make. The less you pay relative value, the more you're going to make. So what does that mean for today? The projections for today are not good. Right now, we're at 111, we're at 1.99 ratio. 1.99. So we're on the cusp of basically being even or down because of this, the way this chart works. This chart isn't exactly linear going down. Why? I don't know. I would have thought it would look like this. That's what it looks like to me. But this is the actual like XY chart. To me, it looks like this, and that determines a really bad return over the next 10 years. But time will tell. I don't know what's going to happen in the future. And that's why I promote dollar cost averaging. Guys, over long periods of time, this is essentially where stock values go. But here's where the price goes. Your job dollar cost average all along the way. Don't think about anything. Now you might sit there and say, well, Paul, you talk about buying stocks. Make sure your savings, go to our retirement calculator in our community, in our software. Make sure you're saving enough every month, dollar cost averaging into low cost ETFs. That way your retirement's set. And then take a portion of money, extra money, and invest in individual companies. And as time goes on, as you get better, start to decrease that amount that you put into the ETFs and increase the amount you put into individual stocks. If we hit 1982 levels, which by the way, stocks don't need to fall 70% to get to 1982 levels. If stocks just fell, call it 50%, which is still a lot, but fundamentals got a lot better, we would have those valuations. And at that point, you're like, why should I pick individual companies when I can just buy the S&P and make 15% a year? Now, do I think we're going to get to 1982 levels? No. Why? Well, they had high interest rates back then. Those high interest rates really drove down valuations. And we had high inflation, which really drove up GDP, which made that ratio even more extreme. But can we get to levels that we were at in the Great Recession? Absolutely. Absolutely. Can we get to better valuations? We will. That's what averages are. They go up and down. So don't get away from that dollar cost averaging. And if you feel like you're missing out on the market right now and you're sitting there, but you're scared of it, still do your dollar cost averaging and keep your extra money to the side and be ready to jump on opportunities. Go out there and grab some. And guess what, guys? Every time you buy, don't expect you're buying at the bottom. That's practically impossible. You should be ready for stocks to fall. And I always tell people the same thing Warren Buffett says. If you can't stand the thought of your stock you buy falling 50%, you shouldn't own the stock. And that can be hard. Peter Lynch said, I bought stocks at 12 that went to 2 and then went up to 50. If as long as the fundamentals are the same or better, as the stock falls, you should love it more. So guys, if you do want to see the stocks that I actually do own that I'm buying, click our next video. It has 18 stocks that I currently own. Thank you for your time.